Welcome to the Mayor of Money podcast series. I'm Rick Goldring. Many of you know me as the Mayor of Burlington between 2010 and 2018. However, prior to serving as mayor, I spent the vast majority of my career in the financial services sector, working with successful business owners in the areas of estate and financial planning and wealth and risk management. And my career continued in the financial services sector with the establishment of Goldring Financial Leadership after my tenure as mayor. This particular podcast series is going to feature topical discussion with some very interesting guests on a wide variety of topics in the areas of estate and financial planning, entrepreneurship, as well as real estate and development. You're going to hear from some lawyers, accountants, pension lawyers even, financial experts, life insurance specialists, and a wide variety of people in that particular sector, along with successful entrepreneurs who will share their wisdom and what they've learned along the way, and people involved in real estate. As real estate, there's a shortage of units in Southern Ontario, and we all know where prices have been in the last couple of years, that real estate is a significant store of wealth. But I'm very pleased today for this particular version of the Mayor of Money podcast to welcome Jean-Pierre Laporte of INTEGRIS Pension Management to the Mayor of Money podcast. JP, good to see you.
Nice to see you.
Welcome to the podcast.
Thanks for having me over.
Now, when I look at your CV and your quite impressive resume, you've achieved a lot in your life. When did you know you wanted to be a pension lawyer? Not just a lawyer, but a pension lawyer.
I never actually decided to be a pension lawyer. I just fell into it. When I started my career, I was paired up with a mentor who said, well, you can't just do corporate law, you have to have a bit of a mixture. So why don't you work with one of my colleagues, another partner? And that partner happened to be working on a massive, massive pension file that actually sucked up about 2 years of my life. And I worked almost exclusively on that one client file for 2 years. And that's how I fell in love with the area of pension law and eventually decided to transition into that specialty.
So you fell in love with pension law. What's the attraction? What really inspired you?
Well, first of all, it's a non-adversarial bar, very collegial. It's a very small bar, so a lot of the lawyers know each other very well and serve together on committees. And it's nice to have clients that have billions and billions of dollars. So you're not always chasing them for payment. You always get paid. And very exciting issues, because we look at trust law, securities law, family law, corporate law, and all kinds of areas of law. So you're really a generalist inside a specialist area, which is an odd situation to be in. But for someone like me, who has eclectic tastes, this was really a nice home to develop my expertise and pick up some experience.
So you're with a few different law firms, and I assume things were going very well. But then you decided around 2012 or 2013, you decided to go out and create INTEGRIS. And create the personal pension plan. And how did you end up doing that?
Well, it's a long story, but I quickly realized that although my clients on Bay Street were doing extremely well with their pension plans, because they were enjoying gold-plated pension plans, which offered massive amounts of payouts in retirement, people like myself as a lawyer, we weren't offered any pension plan. In fact, we were relegated to the RRSP, which is okay, but as you become a higher earner, it only replicates or replaces a small percentage of your pre-retirement income. So it's insufficient as a tool to ensure that you're going to have a comfortable retirement. And my clients who were using defined benefit plans, like classic plans, like teachers and OMERS and so forth, they were okay. They didn't have to worry about their retirement. But people like me, who were in the private sector, and when I say me, I mean all lawyers in Canada pretty much, unless you work for the government, doctors, dentists, accountants, pharmacists, none of them have true pensions. So that's why the idea of creating a miniaturized pension plan that has all of the advantages that teachers and civil servants enjoy and have enjoyed for decades. That's why the idea came to me. And I said, you know what, we need to offer that in the private sector for people like me.
So let's flesh that out a little bit. So if you're working for a municipality, if you're working as a teacher, if you're working in a hospital, if you're working in the public sector, universities, you do get what's called a defined benefit pension plan. And it's a percentage of years of service, typically times the average of your best 5 years. And there's different variations. So there's predictability, there's guarantee that you're going to get a certain income. And typically there is inflation adjustment attached to it. So it's pretty comforting to have that when you retire. But people in the private sector, small business owners, independent lawyers and accountants and people working at CPA firms and doctors and dentists don't have that luxury. They must rely on registered retirement savings plans or other particular forms of saving. So let's talk about the personal pension plan. So how many people do you need to set up a personal pension plan?
Well, it's a team effort, and there are different service providers that do different bits and pieces of the work.
But the point I was making here is the personal pension plan, you only need one person to be part of the plan.
Oh, to be a member, I thought you meant
Yes.
how many people to establish the plan. Yeah, to be a member, you can have a single employee yourself, the shareholder / president of your own company. That's enough to have a personal pension plan. You don't need to offer it to the rank and files employees of your company.
And the reality is that from my experience, working with entrepreneurs and business owners at the very beginning of their careers and their businesses, they're so busy reinvesting in their businesses. And things grow and they build up some wealth in their business, and then often in their 50s and 60s, they're looking to retire, and they may not have set too much money aside other than the value of their business. And the personal pension plan represents a great opportunity. Can you expand on that?
Well, yeah, because you see, the problem is this. If you treat your corporation as your retirement ticket, you're going to sell your business for millions and millions of dollars, and that's how you're going to be able to retire into the sunset. What you're doing is you're building a portfolio, a retirement portfolio with one stock in it, your company, which any financial advisor and planner will tell you is complete folly. But that's what they're doing. They're saying, oh, I'm just going to sell my business. Cash is going to come in, and then I can retire. I can do whatever I want. What they don't realize is that many, many businesses do not have any intrinsic value if you remove the owner and its Rolodex of clients and connections. Third parties don't want to buy the desks and the computers that you've left behind. What they want is the business. They want the clients. They want the revenues tied to those clients. So if the business is too personal in nature, like a doctor, dentist, once that doctor and dentist cannot see patient, there is no real value in the business that they leave behind. So a lot of business owners, about 80%, according to some studies, are going to disaster because they're not setting aside any money for retirement. They're thinking that their business will be what they sell. And then they realize that A, people don't want to buy it at the price they thought it was worth, or two, they don't want to buy it at all. Or if they buy it, they want you to keep working because you're the attraction. You're the one that brings the clients in. So by having a personal pension plan, what we're doing is we're removing that over-concentration risk of having a portfolio with one stock in it, i.e. your company, and putting money aside little by little in an orderly fashion to create an independent power base for yourself once you sell your business. So if you're able to sell your business for a large amount of money, great, that's all gravy. But at least you're going to have a secure, repeatable, predictable cash flow coming out of your pension plan.
So what's the ideal situation? What's the ideal age? What's the ideal set of circumstance when somebody should consider a personal pension plan?
Well, it's a very, very wide net that we've cast, because anybody that has their own corporation that's under the age of 71, if they pay themselves some form of salary or bonus, T4 income, is eligible. Now, it makes more sense if the corporation is able to generate a little bit of a surplus, some retained earnings, because if every penny that the company earns is used to pay salaries and rent and suppliers, and there's nothing left, you're running just threadbare, then of course you don't really have the ability to save in anything, let alone a personal pension plan. But assuming that you're not in dire straits like that, that you are generating some surplus and that you meet those criteria, so you're got your own company, you're under the age of 71, and you're taking a salary, then you qualify for a personal pension plan. Now, that's about 1.4 million Canadians who could do this. But the sweet spot is really when we're talking about family businesses, where mom and dad perhaps started the business, they're getting closer to retirement, and the next generation, the kids, are not only thinking, they're actually working in the family business. When that happens, the real magic of the PPP occurs. Because what we do is we create a family pension plan. Mom and dad and the two kids, for example, are all members of the same plan. And when mom and dad decide to retire, should anything happen to them, let's say they die in a car accident or something, or one dies and then a year later the other one dies or whatever, instead of having half of their wealth taxed away under the Income Tax Act deemed disposition rules, which is what's going to happen in other cases, instead of having that dreadful tax consequence, because this is a pension plan, mom and dad's money is recharacterized as pension surplus. It's surplus because the pension plan doesn't need the money anymore. It can't pay pensions. They're both dead. So because the money stays in the plan, and the kids are also plan members because they're still working in the family business, they didn't die, they inherit all of that surplus without any of that becoming taxable to them immediately. So if you're looking at a $5-6 million pension plan and death occurs, instead of giving $3 million to the government under the deemed disposition rule, you're giving the $3 million to your own children. That's pretty much the stark choice that business owners have. So that's why I say that's where the real magic happens, because the only other product in Canada that allows you to do that would be life insurance. But for that, you have to pay premiums. With us, you don't even have to pay premiums. It's part of, it comes with the package.
So you said something that's pretty significant there. And when I first met with you and some months ago, and you're telling me about the personal pension plan, the fact that in that family business scenario, mom and dad can make their two children beneficiaries of the surplus of the pension upon their passing, and that it can be transferred tax-free. That is significant, because RSPs are 100% taxable when mom and dad die.
RIFs as well, shares of private companies, they're all taxable.
So that's a huge advantage to a personal pension plan compared to RRSPs. But with a personal pension plan, you can contribute a lot more to a personal pension plan than an RSP. And can you explain how that works?
Yeah, so the personal pension plan is governed by pension legislation, not RSP legislation. RSP legislation came about in 1957. Pension legislation traces its origins back to the very first Income Tax Act from 1917, the one that Canada passed to finance the First World War. So the pension rules are significantly more generous than the RSP rules when it comes to tax sheltering money. In fact, when we run statistics and when we do illustrations for our clients, the rule of thumb is that we can triple and sometimes quadruple the amount of tax deductions that you can claim under the Income Tax Act vis-a-vis what you would be allowed to do if you maxed out your RSP every year. So again, the stark choice is, do you want to stay in the RSP and have X dollars, or would you like to quadruple or triple your tax deductions, pay 3-4 times less tax, and have more capital growing tax sheltered for the same level of risk? Because the money is invested the way it would be invested, regardless whether it's an RSP or PPP. We're not in the money management space. So for no extra risk, would you like to end up with 3 or 4 times more money in retirement? Is the question we ask our customers and the general public when they're learning about PPPs.
So that's huge. And I know when I first heard about personal pension plans, and there's different components. So, but say you got a 50-year-old, and they've been putting their maximum into RSP. Does it serve them to switch over to a personal pension plan when they've been maxing out their RSPs?
Oh yeah.
And how would that work for somebody to start an IPP when they already have a significant RSP?
Well, first of all, because of what I said earlier, that the pension legislation is significantly more generous to Canadians who are in a PPP than an RRSP, the fact that you've maxed out your RRSP in the past has no bearing. What happens is we create extra room around the RRSP that you've already contributed. We manufacture more tax deferral room. So one of the things we do is we look at your employment history with your business, and you say, gee, you've been pulling a salary from age 30 to age 50 for the past 20 years. You've been pulling a salary out of your business. Well, we're going to recognize all those years of past service when you sign up for your pension plan. So we're going to create a big tax deduction upfront based on your past service. Then on a current service, we're going to allow you to put more money because you're 50. So you're getting up in there in age. The actuarial rules that we use to calculate the annual contribution allow us to put more money. It could be 5,000, 8,000, 10,000, 20,000 more than the RSP maximum, just in that year. Then we also allow you to do an RRSP contribution, because the RSP contribution is based on the previous year's salary, not the current salaries paid by your company. So you have a double dip in the year of plan setup. You get to deduct twice. Then what happens is, as you invest your money, if the money is invested in a very conservative manner and the internal rate of return is below 7.5%, we have the right to top up your pension plan with additional tax deductions for your company that are called special payments. Now, if you have RRSPs and you roll them into your plan, the investment management fees that were non-deductible because it was an RRSP will now become tax deductible to your business as a bonus. So if you're paying corporate tax at 26.5%, it's as if the cost of investing money dropped by 26.5%. And finally, as you approach retirement, you may decide to turn on the pension sooner than age 65. So you're giving me a 50-year-old example. So let's say the person says, I'd like to start drawing a pension at age 60, so 10 years after I signed up for my PPP. Well, 60, normally when you retire early like that, you end up with a reduced pension. But because of the pension legislation, we're allowed to do another corporate tax deduction, which is really the mother of all tax deductions, which we call terminal funding. And that allows you to capitalize your pension plan sooner to allow you to retire early with an unreduced index pension. So terminal funding deductions, we've seen one go as high as $2.1 million. That's dollar for dollar tax deductible to the business. And Rick, just to put things into context, if you take someone who started contributing to their RRSP in the year 1990, and they maxed out their RRSP every single year, and you added up all of those RRSP contributions, the sum of all those years, 30-some years of RRSP contributions, would be about $580,000. With a single PPP deduction for terminal funding, we could blow that budget, $2 million. Well, that's almost 2-3 times. Well, it's 3 times what you would have been able to do in your whole lifetime with the RSP system. So the two systems are not comparable. And unfortunately, the banks and the insurance companies and all the big financial institutions are always pushing RSP, RSP. You know, we even have RSP season in Canada. That's so Canadian. But that's not the product that business owners need. And so that's why these podcasts are so important, because business owners have to be educated. Their accountants have to learn this. Their financial advisors need to learn this so that they have the right tool to multiply the tax deductions without taking any extra risk.
Now, with RSPs, there's a wide range of investment availability for an RSP. For a PPP, I believe it wouldn't be any different.
It's actually much better.
In what way?
Because the RRSP is governed by what we call the qualifying investment rules. So if you look at the regulations under the Income Tax Act, it gives you a laundry list of the different types of things you're allowed to invest in with RSP monies. The pension plans are not governed by the RSP qualifying rules. They're governed by a different set of rules, again, different legislation, which are called the federal investment rules. And those rules are a lot more permissive and a lot more liberal as to the type of asset classes that you're allowed to invest in. So let me give you an example. Let's say you're a business owner. Let's say you're a farmer. You're a farmer somewhere in southwestern Ontario. You have a very successful farm. And there's a big, big plot of land, another farm that is come up on the market. And you'd love to own that piece of land to add it to your operations. So normally you would go to your credit union or to your bank or wherever and get a mortgage or get a loan and put a down payment and buy that way with after-tax dollars. But with a personal pension plan, the capital inside of your personal pension plan could be used to purchase that piece of raw land. You can't do that with an RSP. It's not eligible for RSP investing, but it is eligible for PPP investing. So now you buy this plot of land, you use it for operations, it generates revenues, and then a developer comes to you 10 years from now and says, we're going to put a subdivision here. Here's a couple $1 million for the land. Thank you very much. When the developer cuts the check to the pension plan and there's a massive capital gain, not taxable. It's a pension plan. So you see, even the asset classes are more, there are more options with a pension plan than using an RSP.
So, okay, I've got to be the devil's advocate here, and I got to say, so what are the negatives? What are the downsides of a PPP in your view? Well, and recognizing you focus on them, there's not going to be much downside, but there's got to be some downside.
No, there's a big downside, and it's that because it's a highly regulated, complicated product that's based on pension law, there's a ton of paperwork when you sign up. You have to sign a plan text, a trust agreement or a funding agreement, a statement of investment policies and procedures, an agency agreement, a consulting agreement with the actuaries. There's all kinds of stuff that you don't have when you go to the bank and you sign up for an RSP online, and 15 minutes later, you can start putting money in your account. Our process can take a couple of months just to collect all of the data, to verify it, to produce the initial actual valuation report, which we then file with CRA to give us the authority to register the plan and to contribute to the plan. All of that is a really, really extensive, time-consuming process. And people that have short attention spans or just can't be bothered, they would rather be in an RSP because 15 minutes, you can start investing. So that's the downside. It's the administrative burden upfront to set it up. Once it's set up, it runs pretty much on its own. But to get over that hump, a lot of people just don't have the energy or the time or the patience. They want instant gratification. So, and you know, we have electronic signatures nowadays. So we remove the big stacks of paper that we used to deliver to people by courier for signature. We do a lot of things electronically, but even with all that, there's still a lot more complexity, and you have to convince the accountant, because the accountant's never heard of it. And the accountant might have a different way of thinking about saving for retirement. They might want to, I don't know, put a family trust in place, or do a estate freeze, or so. Not that these things can't happen with the PPP. I'm just saying that they have to be convinced before the business owner will give the go ahead most of the time. So it's a big investment in time and education that we have to do just to get the person over the hump and signed up with the plan. You don't have that with an RSP. You don't have that with the TFSA. It's quick, away you go.
But as far as the process that goes, I mean, they're through your firm, I assume, you guide the advisor, you guide the client, and you help put together the paperwork, if not put together the paperwork. So as long as the client can provide you with the necessary data, you can get all the paperwork organized.
We do. And I don't want to make it sound like it's, climbing Everest. It's just that compared to the alternative, an RSP,
Right. Yeah.
is a mountain of paperwork, even though we're there to help along the way and we have all the expertise. You were asking me what is the downside, what are the negatives. That is the negative of the PPP, because everything else we're better than the RSP.
Excellent. And now, final question, final area to discuss is, so when you retire, you're 65, anytime before age 71, you must retire, you must convert to an income. What are the options that people have?
Lots of options. So if the business is ongoing, let's say it's a family business and the children have taken over, then one option is just to turn on the pension. So you might have $5-6 million inside the pension fund, but you only get paid whatever, $200,000 a year annual pension. So you only get taxed on that. And another nice feature is that annual pension is eligible for pension income splitting with a spouse. And you don't have to be 65 to pension income split.
Yeah.
So we have a client in Alberta who turned 43 and decided to turn on his pension. So he's splitting his pension with a spouse. And he's paying virtually no tax as a couple because of the splitting. So that's one thing. The other thing I should mention is that if you become a non-resident of Canada, and let's say you move to Florida or Texas or wherever, or some other country, normally under the Income Tax Act, you have two problems. Well, one big problem is that your assets are deemed disposed again. So the government wants to get you one last time with what's called a departure tax.
Yeah.
But the millions of dollars you have in your PPP are exempt from that departure tax. So you pay no tax. So that's number one. Number two, the annual pension is subjected under Part 13 of the Income Tax Act to a non-resident flat withholding rate of 25%. However, Canada and over 100 countries have signed tax treaties, and under those treaties, that 25% withholding tax is reduced to 15%. So that's pretty reasonable amount of tax on that pension you're getting from your PPP when you're a non-resident. So that's something I wanted to mention, is if you're going to keep paying yourself a pension, those are the options. If you don't want to maintain the plan in place, maybe there are no kids to take over the business. Maybe you want to sell the business and the new buyer doesn't want to maintain the pension plan in place for you. Then you have what I call termination options. So the classic termination option is to take your money and to roll it to an RSP or a RIF. And then there'll be a portion that's considered a taxable cash payment. So you get monies rolled into your RSP and then a check. But on that check, there'll be withholding tax. So you don't get the full thing. You have to pay tax on that check, on that cash portion. That's a classic way of dissolving your plan. The other one, which may become more popular with the increase in interest rates, is to buy what's called a copycat annuity. So you take the millions of dollars in your pension plan, you knock on the door of an insurance company and you say, here, that's the premium, replicate what the pension plan would have paid me as a pension. And then you get an annuity, and the annuity payment is what the pension plan would have paid you had you kept the plan going. What the nice thing about it is you're transferring all the risk to the money managers of the insurance company. It's not so good for the financial advisor, of course, who loses these assets. But from the plan member's perspective, because there's a certain provision in the Income Tax Act, that transfer of money over to the insurance company means that you don't have to pay any personal tax.
Right.
So that tax on the cash portion that I was mentioning just before doesn't apply with a copycat annuity. So you could be saving hundreds of thousands of dollars in taxes at the point of plan windup if you really don't want to keep your plan going any longer.
And you're getting,
so lots and lots of, yeah.
And the annuity really is you're able to use your personal pension plan to buy that pension income and get that predictability and guarantee that the public sector has.
Yeah. So you've really replicated what a teacher or a senior civil servant or a unionized worker can do. You've replicated it through the PPP and then buying the copycat annuity.
So we've covered a lot of ground today talking about the PPP, and I thank you for sharing your expertise and your knowledge of the subject, because I think for many people that are watch this, they may have to watch it a second time, but they're going to get a lot of good information out of it, because you really covered it, I thought, extremely well. But just on a personal side, I mean, you've been in business since 2012 or 2013 with INTEGRIS. Things obviously don't go smooth all the time. Are there any books that you've read in your lifetime, personal or professional development books that have, contributed to your success or to who you are today, had any influence on you?
Well, it wouldn't be one of those self-help or business development books, but when I was pretty young, I did read, I think it's Alvin Toffler's book called Future Shock.
Yes.
So I don't know if you've read it as well. But
I haven't read it, but I'm certainly aware of it. And I believe I read some of it some years ago.
And Future Shock was really insightful because it predicted the world that we're living in today in many ways. And it predicted almost the Twitter revolution, having to get a message in 120 characters, and how people are paralyzed by choice, by what he calls hyper choice. Too many options. You sign up for a defined contribution plan and they tell you there are 150 segregated funds to choose from.
That's not helpful. It's not helpful.
No, and so people are frozen by that. And what they do is they go into the default fund, which could be money market, earning you 0.2% interest.
Right.
It completely defeats the purpose of having a pension plan. So when I read that I must have been a teenager, it got me thinking that there's a lot of human psychology that goes into decision making. And some of those lessons I've been able to apply to rolling out the personal pension plan. So, but I guess it's a pretty dated book now. I'm sure there are lots of better books out there. But that's the one, if you're asking me, that's the one that I still remember having an impact.
Well, that's great. And Jean-Pierre Laporte, I want to say thank you very much for taking time to tell us a little bit about yourself, a little bit about INTEGRIS, and a lot about the personal pension plan. And I want to thank everyone for watching or listening to the podcast today. I look forward to hearing from you. If there are particular people that you want me to feature as guests, or particular topics you want me to feature in the discussion, please let me know. So I'm Rick Goldring, the Mayor of Money. Thanks for tuning in, and we'll see you next time on the Mayor of Money podcast. And remember to stay positive and test negative.